works. The way that it graphs is in the same manner that you'd get with any other market, but I like cryptocurrencies because they're so volatile. So say you have Bitcoin here, where it spiked up to what, 20 grand a few days ago?
Yep.
Yeah. And then it went back down to 16. Or not 16, 14.
It did, even a little, it was below, it was like in 13.
Yeah, it hit 12, I think.
It hit 10 that Friday. I had my thumb on the button to buy more too, and I didn't. I bought some at 12, but then it went down to 10.5, and I was like, oh my God, what if it just goes down to 0? Like, I can't.
Yeah. Exactly. So what I'm thinking is, just like anything else in the world, the price of Bitcoin is a function of everything that happens with it. So, and everything that happens around it. So take, for example, I don't know, say you buy stock in a company that produces whiteboards. When the first marker that you could draw on a computer screen with came out, how do you think that affected their stock?
Right.
Yeah. That's some people jumping out of some Wall Street windows right there.
Yeah.
So think about that drop right there, and think about every satellite thing that affects. So if you have the marker industry going down, you have the ink manufacturing industry, the industries that either produce the synthetic ink properties or the mining companies that bring them the stuff that they need.
All of the ancillary,
it's a very large ripple effect. So basically, what I was thinking of doing was, because you have a bunch of cryptocurrencies and you get real-time information on all of them, thanks to applications like the Coinbase thing that I showed you, and
right.
Yeah.
Bitcoin Pro. Is it Crypto Pro? Crypto Pro.
Crypto Pro, yeah. So you have all that stuff. You have a bunch of different market things. We can now do like internet searches on things like SEC regulations, where it pings and tells us using a well-placed Google AI if it's more regulation or less regulation or something. So we can take all those things and we can put it in both as a binary input, which in his case lends itself very well to this. But also, I was thinking we could basically take a graph like this, and I'll go in more depth to some of the semantics. But basically, let's say this is Bitcoin, and say this is Ethereum. And let's say over the course of the past 7 days, they've behaved like this. So different spikes there, but looks like there's a bit of correlation, right? As this goes up, as that goes down, that goes down. Might be a bit of a delay. But what I was thinking was you could do a correlative study where you take all those variables that we have, compare the lines, figure out what percent adherence you get with the Y values versus the X values, see how powerful the similarity is, and then input that as a variable. So you're tracking all the cryptos at once.
So not just Bitcoin and Ethereum, we do all the altcoins, anything I own.
Exactly. Yeah. And different real world markets, like computer stuff.
Like Netflix.
Yes.
You mean stock market?
Yeah, and computer manufacturers in particular.
Why that?
Because if they manufacture something, say, that is capable of mining Bitcoin at a higher rate, then the price might go down because people are expecting that the market will become saturated and there will be more of it. Or say they come out with something and suddenly people want to buy in more because there's more. We'd be able to figure that out by seeing how the lines correlate. And that's where the other binary aspect comes in. So if there's a let me digress a bit. So how do you break down these types of values into the type of binary input that Aniruddha's program needs? So I was thinking we could come up with something called
well, it's a binary output, you mean? Binary output.
Oh, yeah, I mean like a single number here that models everything that's going on right here. Because if you have Ethereum and you're thinking, oh, if that's dropping, this is probably going to drop.
Right.
So where is my backpack?
Over there.
This?
Yeah. Sorry, this is a couple months old thought. I was locked in my house for a period of time with no Wi-Fi, and I had some
Good.
ideas.
It's good to write them down.
Yeah. So I was thinking, if I can find my notes. I know what I was talking about. I'm just trying to find the exact structure that I had for it.
But basically, you're saying kind of like how you have like texture, smoothness,
Right.
whatever. Those have numbers attached to it.
Right.
Each crypto would have that same number.
Right.
Exactly. Screw that though. So basically, if you have, well, kind of, you have the crypto number, but it updates in real time.
Yeah.
And what would happen is, so with the strength of the correlation between each line and the Bitcoin's line, how they affect each other, and we have information dating back years, if not a decade.
From the beginning of Bitcoin.
Exactly.
Like
the
09.
beginning of Bitcoin
Yeah.
and everything else that's sprung up around it.
So it's like 9 years.
And
yeah.
we can just as easily model this around Ethereum too,
Mhm.
because
That's
that's
totally
what
is,
your
yeah.
company's based in most.
It is, yeah.
Because what I'm hoping for is that the AI would be able to buy into everything and make transactions and everything. So basically, depending on the correlation of the line, the program will be analyzing a change right here, and then how similar and how much this is correlated with this. That'll be what I like to call a psi factor.
Mm-hmm.
I think that's close enough. A squiggly factor.
Mm-hmm.
Sure. And then you take that, and it updates itself, the psi rating, given everything that you see from certain areas. And because it's a shifting market, we'd be updating the power of each time interval that feeds in. So like information over the course of the past years is going to take relevance in determining it versus information from Bitcoin's infancy when it was worth like less than 1/100th of a cent.
Mm-hmm. Mm-hmm.
So, and then you plug in a value for how it's, I was thinking its slope. And we could have a set interval of time that the slope is taken over.
Mm-hmm.
And what we would do there is take that, let's call that X, and plug that in for all the different cryptos and a bunch of other stuff too. And in this binary analysis type thing, determine if we think the value of a given crypto is going to rise or fall.
And be able to buy it.
Exactly.
You're trading on this.
We want to be making microtransactions.
Microtransactions.
And the beauty with this is that given the psi factor, which is just the percent correlation between it and all the data sets that we have, we can come up with confidence intervals for how sure we are that it's going to rise or drop. And what I was thinking of doing was, in practical application, the output for any of the given cryptos would be one of two things: buy or sell, which are, it's pretty obvious why you would do that. You buy if you think the price is going to spike, you sell if you think the price is going to drop. And in that way, you can almost short the market because of how volatile it is. So you could wait until it goes down to 10 grand. It predicts it's going to spike back up to 20, so you buy in. And so basically, determining how much you buy would be based on the confidence interval that the program has that the price is going to go up, and by what level the program thinks it's going to go up. So say it's 80% sure that the price is going to go up. That's our confidence interval. Let's say it's predicting a spike of blank. So we'd have a set in parameter that it's supposed to it's supposed to increase its holdings in cryptocurrency Ethereum by 20%. and hold until it predicts that it'll drop. But the thing is, it'll be making these transactions really, really quickly. So, and the third action that it could be taking is to keep. But because of the volatile nature of the currency and the fact, or it never tracks steady, ever. And the fact that it just has so much data, that's highly improbable that it would not predict it to rise or drop within a certain degree. So let's say it's like 51% sure that it's going to rise, which means it's 49% sure that it's going to drop. It might buy like 1/100 of a cent.
Okay, so it won't sell all. It won't always be all in or all. Yeah.
No,
okay.
That's the beauty of it. That's why I want it to have the psi factor, or that's why I want it in terms of that for each of our inputs with the different graphs. And that's why I'm thinking that it's a lower risk option than other things.
Right.
And I'm thinking if it's predicting that everything's going to crash for whatever reason, then it'll pull out and convert everything into US dollars.
Wow. So you have the ability to create this program and attach it to the blockchain and make transactions?
Maybe not the blockchain, if we hook it up to a third-party application.
Like what?
Like the Coinbase type.
Can you do that? Like Bittrex? Well, it would be like Coinbase doesn't do the altcoins, so it would be either Bittrex or Binance. They let you do that?
Well, there
they have APIs?
There would be two. There'd be two applications that we hooked up to. First one is that, like the Pro thing, the Crypto Pro.
Crypto Pro, yeah.
Something like that, where it updates as fast as we can possibly get it to. We'd want a computer tasked with this at all times. And
but you guys, everything is open source on GitHub. Like, can't you just connect directly to the blockchain and do all this on your own? That's the beauty of the blockchain, isn't it? That it's decentralized.
Probably. I'm not the programming guy. This is.
Oh, okay.
I'm completely clueless.
Okay.
But, I think you probably could do that. Like, there's a lot of open source code on GitHub. So
and I think Bitcoin's open source. I think that's the idea. So I think there's a way it would be cleaner for you to just do it all directly as opposed to trying to get APIs and stuff like that.
Right. All right. So we do it all directly, but basically, all we need is something we can buy and sell stuff in, preferably as much as possible, and access to as much data about every financial market ever.
Every financial market.
That we want to put in.
Yeah.
So, like, people say the price of tea in China.
Yeah.
We might not want that, but...
yeah, I get that.
Yeah.
Would you guys want to start with like my crypto, like just say I wanted to do this with you guys for $1,000 in cryptocurrency. Would it be just Bitcoin you'd want, or would you want various cryptos? I think starting with Bitcoin and buying and selling from there, right?
Yeah, we'd have to work out what exactly we're going to do with, because what I was thinking was, and this could get a little bit more complicated in programming terms, sorry.
Yeah.
But basically, because it's going to be predicting that something might rise or fall at any given time, it's predicting that Bitcoin's going to drop, but Ethereum's going up. So it might buy Ethereum with Bitcoin and vice versa.
Yep.
Cutting out the third party of converting back into US dollars. And that would be probably a hell of a lot more complicated.
Yeah.
But
I think in programming terms, you would probably want to start off with one cryptocurrency.
One currency.
Get that to work.
Okay.
Yeah,
and then we could
we'd spread out. But what I'm thinking is once we diversify, what we want to do is just as like a starting off point, we figure out, or so we let the program run, and we don't even have to have any money in it. It should just be able to predict what's going to happen. Like it'll produce a projected thing for a certain interval of time, and it'll probably only be one slope of the line because it can't predict the future. It wouldn't be that good of an AI, but it would predict, oh, this is going to go up, and it's going to have a $200 increase over the course of the next 3 days, or probably less because we're talking about minute by minute. But basically, we just take everything and spread it based on what we think is going to happen. And so if something is dropping, we wouldn't put the currency into it initially until it predicts that it's going to rise. And then we put it in, and once we have diversified holdings, it'll be switching around in between it. And
on its own, with no input from us.
Hopefully not, if the programming's good enough.
Right.
Future wink there. But yeah, hopefully what would happen is it's like a shell game almost, where it's trying to grow the shell. And
where do my assets live? So I give that to you guys. Is it still in my private key, like my Bitcoin wallet? Does it just come directly from there, or am I actually transferring Bitcoin to you guys that you guys are then playing with?
That I think would kind of be up to you. I'm not quite sure it's too important.
I feel like you can do it either way.
It's whatever host account you'd want, I think, because you just run the program, and all the assets are still in the name of the holder.
And so you guys wouldn't actually, in theory, have access to my you understand? Do you guys know about private keys on blockchain?
Yeah, the concept that you own it and it's
so like anyone that so the private key is like the really important thing. There's a public key that, like, if I want you to send me some Bitcoin, I send you my wallet address. That's a public key. And you send me money. The private key is basically like having cash. So it's this long number that, like, if you have good memory, you can cross borders with billions of dollars. And whoever has access, holds that, owns it. That's it. So basically, if I give you my private key, then you guys basically own the Bitcoin.
Or is like the private key like the thing where, like, they do for encryption, where, like, they'll have like this really long number, and then the private key would just be like a prime factor.
No, the private key is the long number.
We'd need the private key if that's what you need in order to transfer funds from one thing to another.
No, that's the public key.
You only need the public key to spend another person's money?
Oh, well, no, the private key to spend the money, yeah. So you would. So I would probably, what I would want to do then is put whatever amount of Bitcoin it is, I'd create a new wallet.
You'd want your own wallet specifically for use
for just this thing.
Yeah.
But then that means you guys would have access to it. So then, if, say for example, $1,000, turn into $1 million, all three of us, whoever has access to that private key, basically, can just take it.
We'd have to sign up a contract.
Yeah, something like that.
Beforehand, because if we, by some miracle, make like $1 billion, I don't know, just leave it on for like 24 hours and it works way better than we thought it did.
Which in the crypto market, you never know. The way these things are so volatile, especially
I'm thinking that we'll also have a, what I like to call a cash out area. Like I said, where it converts to US dollars, but just generally, if it gets up into the level of money where we genuinely miss it if we lost it, if it spikes spontaneously to
like $100,000.
Yeah.
Just take cash the whole thing out.
Yes. Yeah. And reinvest with whatever we think is
right. And is that possible to do in the program you're creating?
Yeah. Definitely. It's all just thresholds, and it would work on its own.
Great.
It all sounds correct to you?
Yeah.
All right.
How do we do this?
So you have your source code for your thing. I can write up the math, hopefully. Yeah. I might need some help from you and my father, but I should figure it out pretty well. It's not too complicated.
January is, I don't know if you know this in the crypto world, January tends to be like dead. Like Bitcoin goes down, everything goes down, and then February, phew.
So maybe we work on it, try to get it done by February, because then we can appreciate the meteoric rise from our room at the Ritz.
Wait, what?
No, I'm joking. If it makes us $1 million overnight.
Exactly. Millionaire high school students.
There you go. So that's our idea.